Today, how independent is the RBA really? Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and property news with a distinctively Australian flavour. Well, we know that rates are going up, even the RBA confirms this, and now our new Prime Minister has stepped in saying the central bank needs to be careful. So what's going on? Well, first, Westpac has increased its home loan variable interest rates for the second time in the space of a month. On Wednesday, Westpac's mortgage rates for new and existing customers went up by 0.5 percentage point, and it comes after it raised home loan variable interest rates by the same amount for new and existing customers on June the 21st. Australia's second largest home loan lender also hiked its fixed home loan rates by up to 0.6 percentage points for both owner-occupiers and investors. That's on all fixed-term rates. 1 to 3 year rates for owner-occupier and paying principal interest on their loans have increased by 0.5 percentage points, while the rate spiked by 0.6 percentage points for 4 to 5 year rates. Now, it's the second time in the space of a month that Westpac has made changes after it increased home loan variable interest rates by 0.5 percentage points for new existing customers on June 21. Rate City Research Director Sally Tyndall said fixed mortgage rates starting with a 5 or a 6 were the new norm for the big four banks, and she said that the ultra-low interest rates of under 2% were now a distant memory. It's hard to believe that just a year ago Westpac was offering a 2-year fixed rate at 1.89% for owner-occupiers. Now that rate has almost tripled to 5.39%. The comments come as Big Four lender ANZ forecast a further 4 back-to-back 0.5 percentage point increases in the interest rates from August, taking the cash rate from 1.35% in May to 3.35% by the end of 2022. So for a typical $500,000 mortgage with 25 years left to run, the shift from a record low 0.1% cash rate to 3.35% would add around $909 to monthly repayments and $1,363 a month for a mortgage of $750,000. But for someone with a $1 million mortgage, repayments could rise by a total of $1,818, according to Rate City. Now, Dr. Lowe has stressed the need to get annual inflation, currently at 5.1% officially, although higher, I think, in real terms, and forecast to hit 7% officially, back to target, which will require more increases in the cash rate above the current 1.35%. If we take the 2.5% midpoint of the inflation target as a reasonable estimate of medium-term inflation expectations, this suggests the neutral nominal cash rate is at least 2.5%, he just said. Though the cash rate could go higher and the governor emphasised that neutral was just a reference point, it is not the basis of a mechanical rule, and we're not on a preset path to achieve any specific level of the cash rate. If inflation expectations shift up and businesses and workers come to expect higher rates of inflation on an ongoing basis, it will be harder to return inflation to target. Doing so would require high interest rates, he said. The RBA's mindset was one of steady increases in interest rates now to forestall a persistent shift in inflation and inflation expectations, he said. And of course, Dr. Lowe's deputy, Michelle Bullock, on Tuesday said the cash rate at 1.35% was still probably well below where it needed to be to move, but households were well placed to manage further increases. Well, we discussed that nonsense yesterday in an earlier post, highlighting that bank data did not support that view and how myopic the RBA's storytelling was. Check it out. Meanwhile, Treasurer Jim Chalmers, Reserve Bank Governor Philip Lowe and business bosses have backed Australia's 2 to 3% flexible inflation target that could underpin a doubling of the official interest rate in coming months. National Australia Bank Chief Executive Ross McEwen said he would be very surprised if the target was dumped, while BHP Chief Financial Officer David Lamont said he supported the existing interest rate framework. Having that certainty gives us a lot of more certainty to plan what we invest back into the country, Lamont said on Wednesday. In announcing the terms of reference and panel members for the first review of the Reserve Bank since 1981, Dr. Chalmers backed the current inflation target but acknowledged it would be the main focus of the inquiry. Mr. McEwen backed that outlook, saying most customers had the savings to absorb higher mortgage repayments and were in pretty good shape. And he pointed to the huge $260 billion in savings amassed during the pandemic. Funny how that number keeps going up. A lot of that's still sitting in bank accounts, so there's a resilience there that we haven't seen for quite some time, both individual and small business people. There's good resilience in this economy, and 3.5% unemployment is the best it's been in decades. It's a resilience we haven't seen for quite some time. Dr. Lowe said that the RBA was focused on ensuring inflation psychology did not shift higher, and was pleased financial markets were confident inflation would return to the RBA's target band over the medium term. If people setting prices and wages believe higher inflation will persist, they are more likely to push prices and wages up, he said. This could result in a self-reinforcing cycle, one in which higher inflation leads to firms being more willing to put their prices up and agree to larger wage claims. Part of keeping inflation expectations low, according to many economists, is maintaining that credible and flexible 2 to 3% inflation target, though this view is not universally accepted. Economists, including the University of Queensland Professor John Quiglen and Nobel laureate Joseph Stiglitz, argue existing central bank targets should be higher to allow for more inflation in the economy. Others, such as ANU Professor Warwick McKibben, argue inflation targeting should be dumped and replaced with nominal economic growth targets. But Dr. Chalmers on Wednesday talked up the existing approach. I haven't yet had proposed to me a version of inflation targeting regime which is better than the one that we have, the Treasurer said, but I've got an open mind to that change and other perspectives on that. I think it's important that we give the panellists and the review team the capacity to look at that properly. With the review set to be handed to Dr. Chalmers next March, Dr. Lowe was resistant to changing the target and said he would need to assess any such recommendation and discuss it with the government. In most other countries that have reviewed their inflation targeting arrangements, they've come to the conclusion a flexible inflation target centred somewhere around the 2% mark is the best we can do, he said. I don't want to prejudice the conclusion of the review, but I think the general conclusion that flexible, medium-term inflation targeting is the right monetary policy framework is a pretty robust conclusion. My view is that flexible inflation targeting, while it has some limitations, is the best monetary policy set of arrangements for Australia, and we'll look at how best to implement flexible medium-term inflation targeting. Former Bank of Canada Senior Deputy Governor Caroline Wilkins, ANU Economics Professor Renee Fry-McKibben, and former Senior Treasury official Gordon de Brown have been appointed to oversee the RBA review. The broad terms of reference for the review, released by Dr. Chalmers, showed it will be charged with ensuring monetary policy arrangements and the operations of the bank further support strong economic outcomes. Ms. Wilkins in 2018 said Canada's 1 to 3% inflation band, which is similar to Australia's, had served the country well and had supported low, stable and predictable inflation in the past. Ms. Wilkins also said research suggested inflation higher than Canada's 1 to 3% range will be felt by everyone and most acutely by people living on fixed or lower incomes. Moreover, we were concerned the bank's credibility would be undermined if people thought it was a slippery slope to even higher rates, Ms. Wilkins said in a 2018 speech. Her remarks came before the COVID-19 pandemic and ahead of a Bank of Canada review of alternatives to inflation targeting, which she said was important to look for ways to improve. And that review found that in the end, no alternative was better than flexible inflation targeting, though important lessons were learnt that could be used to improve Canada's monetary policy settings. Professor Fry-McKibben, in 2014, a non-peered academic paper co-written with a research student, noted inflation targets tended to insulate advanced economies during economic downturns, but was less helpful for developing countries. Developed and emerging countries need to evaluate their choice of monetary regime by taking into account the trade-off between low and stable inflation during normal periods with growth during downturns, they wrote in Does Inflation Targeting Outperform Alternative Policies During Global Downturns? And Shadow Treasurer Angus Taylor said it was important the RBA remained clearly focused on the 2 to 3% inflation target. We shouldn't be distracted from that core, which is to manage inflation and give investors and borrowers the confidence they need. This is enormously important, Mr. Taylor said. But Anthony Albanese has warned the Reserve Bank against overreach as it races to hike interest rates to contain inflation. As the Reserve Bank Governor Philip Lowe concluded the RBA may have over-insured against the pandemic with low interest rates, contributing to the inflation crisis now gripping the nation, the Prime Minister has urged caution, warning there was real pressure on families. He said he hoped that rates would not rise as hard and fast as some analysts, including the ANZ Bank, have predicted. Well, of course, the Reserve Bank sets those rates independently of government, Mr Albanese said, but they need to be careful that they don't overreach as well. Of course, the Reserve Bank declared a while ago, and they've conceded the error, that interest rates would stay at the extraordinary low levels where they were for a period of years up to 2024, and that hasn't been the case. 3AW radio host Neil Mitchell then interjected, well, that's hurt people. They were wrong. Are you saying make sure they don't go too hard this time? Well, they need to make sure that they get the assessment right, the Prime Minister responded. There are some circumstances that could not have been foreseen. One thing that has been a real impact globally is the Russian invasion of Ukraine. That has had an impact on energy prices that then has gone through to supply chains and had a real impact right around the world. In a mea culpa of sorts over widespread criticisms the bank had kept interest rates too low for too long, Dr. Lowe said it was a scary time and the RBA and the previous Morrison government wanted to save jobs. Looking back at this experience with hindsight, I can understand why some people might conclude that too much support was provided by governments and by the central banks. He said, the Prime Minister's comments come after Sunrise host David Koch slammed the Reserve Bank as negligent and asked if it was derelict in its duty of telling homeowners they wouldn't raise rates before slamming on the accelerator with successive rate hikes to curb inflation. Talking to Treasurer Jim Chalmers on Tuesday morning, Koch said there were real questions over the RBA's recent advice to homeowners. Late last year, November, December, the Reserve Bank, Philip Lowe, was telling Aussies to go out and borrow as much as you like, on the understanding that I'm not going to put up official interest rates until 2024. The presenter said a couple of months later, they started putting up rates. Was that advice to the average Australian negligent? Were they derelict in their duty to lead average Australians up the garden path to get themselves into debt? Governor Philip Lowe has talked about that at some length, about that guidance that he gave, and about how he considers the economic conditions to have changed faster than the bank anticipated. And Sunrise responded that you've been very polite with all of this, but the reality is the market at the time was saying to the Reserve Bank, to everyone, saying inflation is roaring back, you're going to have to put up interest rates, you're going to have to do it quickly to get ahead of that curve on inflation, he said. The Reserve Bank didn't, they did the opposite. And that's why our inflation has got a bit out of control. We're lagging the rest of the world. Surely that is negligence on the part of the Reserve Bank. And the Treasurer said the inflation challenge was not purely a consequence of decisions taken by the Reserve Bank, and said there were both domestic and international elements in rising prices, including the war in Ukraine. And so I think it would be unfair to pin it all on the Reserve Bank. But here we are now with the Prime Minister effectively signalling publicly that the Reserve Bank needs to be careful. So the question is, how independent is the Reserve Bank? And my suspicion is that as rates rise and as people get into more difficulty, there will be quiet conversations between our banks, the regulators, and government, and the pressure will be applied to try and get the RBA to turn turtle. Now, the question is, how soon will they, if they do, and what will be the consequences? But I want to ask this question: how independent is the RBA really? My answer is not as much as you may think. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.